Hi there, everyone. It's great to be with you once again. We've got a Facebook Live today with one of our favorite people in the whole world, a dear friend of mine and someone who's so well respected. She's a friend of ours. Everybody knows who I'm talking about. It's Ivy Zelman. Hi, Ivy. How are you?
Great. Thanks for having me on, Barry. Love
Oh,
being
it's
here with you.
it's really great to be with you. And Ivy, a lot of people now that I just want to try and jump right in. A lot of people now talking about the housing market being so hot. Is it perhaps too hot? Are we looking at the potential for a reversal in the marketplace as far as pricing? Are we in a position where we could see prices start to decline? And I know there's a lot of misconception, which we go over with our clients that explains to them that we don't look at median home price, we look at actual appreciation, that some of the slowdown that we're seeing in the pace of sales, obviously some of it is seasonal, we know that, but we also know that it could be from a lack of inventory. But you always have such cutting edge information, especially from the builder side on the new construction front, and also some great demographic information. So let's focus on what your thoughts are first as an overview of the housing market, and if you still think that it will continue to show signs of appreciation, or are you starting to see some signs that should make us be concerned?
Well, overall, I'd say that we think the housing market is running too hot. And I think that the market is not likely to be sustained at the current pace. And that should not be a surprise to everyone or anyone. And when you think about where mortgage rates are today and the continuation of really what I like to refer to as sort of free money, thanks to the J team, we've got, plenty of liquidity allowing for people to capitalize on that phenomena. But I do think what we're starting to see is a bit of a pushback from consumers. You think at some point, how do you cure inflation? You keep raising prices till the buyer says, no, thank you. And where we're seeing the most inflection point really is in the builder market, where, thinking about this constraints on supply, we all recognize we don't believe home prices will go down nationally. We're forecasting that home prices will continue to rise at a pretty strong pace this year. It starts to decelerate in 22, and then 23, we get to pretty much almost 1% in 23. And part of that is really due to the increasing supply that we're seeing from the builder market. So single family development, where you see predominantly the smile states, or we like to used to call the sand states, pretty much in those markets where you can bring a lot of new construction, that's where the home prices might start to see are more at risk of correcting. And so where you're in a market where there's no inventory, then there's very little production housing, you might see deceleration in home prices, but I don't think that you're going to see home prices outright correct.
So
Of
Ivy,
course,
let's unpack that a little bit. So the first big point there, and we completely agree with you that the housing market is hotter than we'd like it to be. We also think that the housing market, would be healthy for it to slow down. We'd hope that that would occur, but it seems like while one cure might be, high prices is the cure for high prices, another cure would be bringing more inventory to the market. And you mentioned the smile states, which I guess if you put a smile or a U around the United States, we're talking about those that would be around that circumference on the lower side of the United States, left, right, and bottom. Tell us, are there any states in particular where you see perhaps more inventory coming on the market than can easily be absorbed?
I think it's a combination of factors. So where I'm most concerned would be in areas like Phoenix, Austin, Houston, Dallas, the Atlanta area, Carolinas. We're seeing markets where not only are we seeing significant land inflation in those markets. So everything starts with the land sellers. They're sort of the tip of the iceberg. And as you think about the position they're in today, because of such an accommodative policy and free money, single family overall is really the prettiest girl at the dance right now when you look at various asset classes for, trying to diversify, and all this capital needs to be deployed, because these various large funds that are raising money and getting investors to provide them capital, they have to pay them back and they can't sit on cash. So institutional money has been entering the single family development space in a big way to do purposely built for rent. And in the last 18 to 24 months, unlevered, at least what's just been publicly announced, and it may not be a big number compared to what's being spent in other commercial real estate asset classes, but it's about 40 billion that's been announced. And what we're seeing in the Smile states is that pretty much the money is kind of like a sheep, they're all herding to the same place. So when you go into Phoenix, sort of the classic example, they're bidding up lot prices that the for sale guys are also trying to buy to provide the theoretical machine that they have to replace the existing communities they're building with eventually this land that they'll put back into the capacity utilization or put into the plant, the theoretical plant. So land prices nationally through the first quarter of 2021, according to our proprietary land development survey, were up 24%. And that's nationally. We know there are parts of Arizona where lot prices are up 50+%. And so if you look at that, what does that mean? Well, that means that you're going to have, if you're a builder, whether you're building purposely built for rent or you're building for sale, that you're having to buy an inflated asset. So you're going to have to, in order to sustain your ability to provide the returns you promise to your clientele, you've got to raise prices to your end market, to your renter or to your buyer. And then you also have massive inflation. The cost of goods sold is three components. You've got labor, a third, land, a third, and materials, a third. And they're all up significantly. Labor and materials are up double digit. And depending on the market, like Phoenix, there's a finite number of trades. When we had the great financial crisis, a lot of our illegals left. They went to different areas. We've got, e-verification. And it's not like we've done a good job, the industry that is, recruiting high school kids or people to come pound nails at 100 degrees in Phoenix when they can work in the Apple store. So it's very limited, causing inflation. And then you have, call it 20 to 25 categories in the material segment. Everybody focuses on lumber. Lumber is significant. It's normally 4 to 5% of cost of goods sold. It's currently gone up to 9 to 10%, although it's come back down. The builders aren't seeing that benefit yet because they're still dealing with all the stock that needs to be sold at the higher levels. But we track every category beyond lumber, call it 20 to 25 categories that are ranging up double digit to up as much as 40%.
Yeah, the Ivy, and then obviously soft costs are also something that we are understanding, just even anecdotally, that people are telling us are getting more difficult and more expensive. The soft costs that go into putting something together, especially in a planned development.
When you say soft cost, you mean like sewer
Legal,
pipes? Oh.
legal permit, things of that nature, that we understand that it's taking longer and it's costing more to get all that stuff done too.
Well, absolutely. And by the way, forget the cost. It's even sourcing it. I mean, the containers that are sourced from Asia, the inflation used to be, or the container would cost 2,000. Now it's 12,000, and there's not enough containers. So it's not enough flatbed trucks. People can't get product. So the builders that are in better position, that have the resources, are really winning. But we went from builders flat out in Dallas, as an example, last July, talking to builders that were, one builder said, I'm outright giddy. But now fast forward, he says, I remember outright giddy. He says, now I'm terrified. And this is someone who's building several thousand homes a year, not a little one or two, onesie twosie builder, because there's just too much inflation in the system there. So what we're seeing now, which is really scaring the consumer, is that, I'll give you an example. So we get Google alerts on every article published as anything to do with housing. My team of 12, is constantly getting information and aggregating. And this poor woman lives in San Antonio and buys her first house for $365,000, probably got the number wrong, but around there. And it's like near Beautiful Tree. And guess what happens? The builder cancels her, unbeknownst to her, and resells it $100,000 higher. So this is in the local papers in San Antonio. Fast forward now, what are builders doing? Because there's variability in the cost they underwrote to the consumer. Let's say you signed a contract, you bought a house for $350,000. By the time they close that house will cost them $50,000 to $75,000 more to finish. So they're now putting escalators into the house to tell the consumer, you're going to have to absorb that. And some of them will cancel, and some of them will continue and will pay the higher amounts.
So
go ahead.
So when we talk about this, I mean, and that's really, it's crazy to me how so many people look at the housing market and they don't look at it to other markets. Like for example, in the stock market, you've got different sectors. You've got energy, technology, healthcare, you know, consumer staples, things of that. And you look at those different areas of the stock market, but yet in the housing market, it would seem so logical to look at the housing market as far as, you know, even first time home buyers, first move up, you know, luxury, and most people just blanket it all together. So when we talk about these costs that are being pushed higher, and maybe just possibly some of the labor costs start to become a little less pressured after Labor Day when people aren't being paid 18 bucks an hour to stay home. Maybe, I'm not 100% sure, but that's probably why it is so difficult to solve this problem. Because if you're looking for a home, depending on the market you're in, it's a little easier on the upper end to find a home. But if you're entering the marketplace, it is very, very difficult. And the way to increase supply there is for builders to build there, but the costs are making it difficult. Could you walk us through what you would think? And I know it's going to be different. So this is just an exercise, just conceptually. You're paying for land, that's a lot. You got all the soft costs we talked about, and then cost per square foot to build, and then heck, you know, you want to make a profit, right? And then costs to carry the financing. When you put all that together, is it almost impossible to build a home for less than $250,000 today?
Yes, impossible. I
Yeah.
mean, I think that we're in the threes now, that you can't even get probably high threes. I mean, it's really, there's probably some builders in certain rural markets. I'm not going to rule that out, but in the top metro markets, we're in the threes. What I would say, which was really concerning, is that the starting with the land development piece, but we go back to the resale market. You know, my dad's in Houston. I go to Houston and I have a little cocktail hour with some of my friends. First COVID little roundtable I hosted, post COVID, I should say. Not really, I guess we're in COVID still. But I wind up having two brokers, two lenders, a builder. And, you know, they're talking about the fact that the buyer, the primary buyer, and we know this, is competing with iBuyers, is competing with fix and flip buyers, SFR buyers, and then just average mom and pop investors that want to be diversified and want to own real estate. And of course, second homeowners that might be co-primary. So, you know, the market has had, just in the analogies to the great financial crisis, the only analogy I make is the mortgage market is sound and the mortgage market is healthy, thank God, is what Jay Powell is missing, which I'd like to tell him to listen up, is that yes, the mortgage market is sound, but when you have that much capital chasing a finite number of homes, it's going to make the primary buyer, the very buyer you're trying to help, is not going to be able to afford it. And appraised values are coming in well below. So in Houston, I was looking for a house for my father just because they live in a tiny townhome and he's in a wheelchair and he's got a walker and it's not enough space. So I see a house for 285,000. I'm like, holy shit, that's pretty, excuse the language. That's a good, you know, seems like a relatively cheap home and a nice ranch, a nice area. And the woman says, the realtor, the premier agent that I got a hold of, took too long, impatient Ivy, didn't like to wait. And this woman finally calls me, very nice lady, Natasha. And she calls me and she's, well, the house is 50,000 above appraised value and the bay window is leaking, but I bet you can make a low ball offer. She's like, but it's been 54 days. She says, I'm telling you, the market's really slowing. And I said, yo, I've heard that. I've heard that. So our broker survey, our builder survey, I'd say June, are people back out traveling? I mean, you're traveling, I'm traveling. Housing is no longer center stage. But what's really concerning to me is the number of companies out there that are not only raising prices to the consumer because they believe that pricing is inelastic. They think the demand, is inelastic. They think that the consumer doesn't have a choice. Consumer has to pay more, and that's just what their decision is going to be. They're going to take more of their discretionary income and they're going to allocate that income, not discretionary, the non-discretionary income. They're just going to have to put more to housing because they live there, they work there. That's their choice. What we don't realize is that a lot of people went out during the initial shutdown and they bought a second home. Look at Connecticut. Connecticut was dead. Greenwich, everywhere. You couldn't sell a move-up house there. You couldn't sell a luxury home there. It was dead as a doornail. They were still below prior peak values. They were below where they eventually realized they're never going to sell this house, and they were call it buyer or seller strike. In Connecticut for 2020, off a low base, second home sales are up 74%. Now, again, off a low base, but think of this. How many people ran out and bought a house? So how much demand do we pull forward? And that's really one of the things we're trying to understand. But I feel terrible for the consumer. One last thing and I'll shut up. So in Atlanta, so Clayton County, which I've never heard of until I read this article, had approved affordable homes, 220 unit project for affordable homes. And one of the rental companies bought the entire thing. And now there's no affordable homes to be allocated to the buyers. It's all for renters.
Yeah, this is very it's a real difficult circumstance if you're trying to buy a home. So a couple of things that I just want to make sure we underscore and we get, and I have two questions for you too on this, maybe three. But the first one is that we are, and I'm glad you said this before, but you said it kind of quick. So I just want to make sure everybody understands this because we feel the same way, that there's a big difference between decelerating appreciation and depreciation of homes. So the way we feel about it, and from what I'm hearing from you is the way you feel about it, is we're not looking at, and again, housing is very local, so let's do that caveat. In general, we're not looking at home prices declining, but the pace of appreciation and this is very welcome, would more than likely be decelerating. And from that, when we hear stories about homes are slowing, this and that, and there's a lot of mistakes people make. I mean, I know you watch your updates every day, and one of the things people make mistakes on is they don't take into consideration, they look at the mortgage application data, but we don't realize there's been a 50% rise in the amount of cash buyers, and they aren't contemplated in the mortgage application data. So when you see cash buyers going from 16, 17% to 24, 25%, that's not reflected in the mortgage application data. So purchases on mortgage apps come down and say, oh, it's slowing. No, it's not slowing. There's more people buying for cash that's not being in there, plus the fact that we have less inventory to choose from. So one other thing that is in regards to this inventory that I wanted to ask you, because you really know this stuff better than anyone, the auto sector is facing some real difficult times. And if those of us that are looking for cars, first of all, this is a great time to sell a used car if you have extra cars, because you'll get an incredible amount for that used car because there's such demand. But showrooms have like nothing in there for car dealers. And the big problem that they're facing is the semiconductor shortage, which is really, they come out of Taiwan. And I didn't know this until I researched it. But do you know there's 3,000 semiconductor chips that go into a vehicle? Is that crazy?
Didn't know that.
Homes today are built with a lot of technology, I would imagine, right? For much of what goes in there. Is this chip shortage also impacting homes, not just driving up the price, but allowing fewer homes to be completed?
Well, I mean, I don't know about the chips, but I can tell you that a builder I spoke with last week said he had a buyer that was moving and closing and they didn't have a stove, and they had to go find another stove from somewhere. So there's appliance shortages, it's inability to get all of the various, call it plumbing, within the ecosystem to make sure that the consumer has everything they need to close, does create delays. Cycle times are elongated substantially. We have a slide in our PowerPoint that shows you every category, how far cycle times are extended versus normal. And many of them are double, triple. I mean, I think that, no question, whether that's because the containers or there's some technology aspect, but it's across the board. I do think though, let me be clear about something about pricing. So if I bought a home right now in any part of the country, with maybe the exception of New York City, or they'll say the cities of our country where they got hit hard because of COVID, whether LA or San Francisco, I think that top tick would be at risk of being lower than the value you paid for it. So we have to think about the incremental unit. So if I bought that house for my dad at 285, that value would go down. So if you own today, and the good news is there's so much equity, there's so much skin in the game for the consumer. They've seen so much appreciation. So when would they see some of that appreciation potentially come under pressure because the top of the market doesn't sustain? Yes. I don't think we're going to have anything close to any type of concerning correction in my world. I don't know. Don't ask me about the other world, but my world, I'm not worried about a housing bubble. But I do think that we have, some concern that the consumer at this point, again, it's being clouded by non-primary buyers. And you said cash buyers. We know a lot of the buyers are levering up in funds prior to going out and paying with cash. So there's debt behind those cash buyers in many cases. And there are, so we're not so convinced that, that's just immaterial. Don't worry, it's cash buyers. But inventory in the United States, as constrained as it may be, that the backlash of a refi boom, which by the way, I was looking at numbers from 2018. In 2018, at the end of the year, the number of homeowners that had a mortgage rate locked in below 4% was roughly 39%. If you look at where it is today, under 4% is over 60%, 63%.
So Ivy, there's a few things there. So I want to unpack what you just said, because there's a lot of good stuff there. So first thing for all of you listening, you've got the media, which always loves to take a negative slant. We know that already. And they're talking about, oh, housing's slowing, housing's hit peak, housing's going to crash, so that blah, blah, blah. But when you see less sales or less closings transpiring, remember what Ivy's saying here, and we talked about the chips. So I brought up chips, and Ivy's saying, well, all these appliances, she's actually seeing delays. So to bring new inventory to market, it doesn't mean there's not demand. It doesn't mean there's not strength or desire, but you're not going to get the closing numbers. So people go, oh, it's slowing. It's not slowing because it is a lack of will or ability to purchase.
But it is on the margin. We're starting to see like where communities are opening, because builders had a very hard time bringing new communities on because they sold out of their existing communities so quickly. And there were so many delays. They delayed initially buying land. So there was a period of time where there was no new communities coming online, and municipalities were delaying because they were shut down. The communities that are coming online now, the buyer demand is waning a bit. And we're starting to see where we had a builder who opened a community, total bust, hundreds on the waiting list, nobody showed up. Whereas another community up the street from where that one was, they did very well. So we're starting to see a little bit of the consumer starting to say, you know what, I'm not buying here. So when you think about closings, I frankly don't care about closings from a macro, number. Doesn't matter to me. My front line is what the new orders are. And our new orders for June were down 51%. Now, admittedly, that was a tough comparison because June was gangbusters last year, but also about 60% of our builders have been limiting sales because they can't sell more because they're getting too far out for the existing homeowner or, today's signed contract. But when I was in Texas and I'm in Houston, the builder that came, who operates throughout the whole state, he's like, I really can't speak to demand because we're closed in 3 of the 4 MSAs we build in. We're not selling. And so when we looked at incentives, so we track what percent, and we're surveying several hundred builders, what percent offer incentives? Would you kill a bug or something? So,
No.
all right. So what percent offer incentives? And the answer in May was 2%, which is historically like the lowest level. In June, it was 7%. So there are builders. I had one builder in a mountain state, large builder, told me they started offering incentives and all the other builders got mad. I go, why were you offering incentives? They said, because the local buyer can't afford it. You go to Jackson Hole, you go to Sun Valley, Idaho, you go to the Hamptons, you go anywhere you want to go on vacation. There are people living in cars. There's nowhere for them to live. They can't afford it. And you know what? This is not because they don't want to work, but they have nowhere to live in these very affluent resort towns. There's not enough housing. So we've got a hell of a problem, but we have institutional investors, we've got investors, we've got non-primary buyers that are buying up, like in Napa, in St. Helena, and all these areas. You've got Spencer Rakoff, who started a company where he wants to buy up homes to do timeshare, basically. And they told him, stop buying our homes. Stop buying our homes in this neighborhood. they had an ordinance that says you can't buy them home for investors. I don't know what's going to happen. I'm just saying the consumers.
So Ivy, so let's shift gears for a second to we know we have a problem. We know the cost to build is difficult, and at least for the time being, the actual delivery of new inventory is difficult. And really, this is the engine that creates inventory, right? Because if you have a buyer that sells their existing home, you temporarily create inventory, but now you have another competing buyer on the market that needs a place to live. So that's not really adding much inventory. What you're going to add inventory from the new construction side to alleviate this issue.
You can
But
add
now,
inventory through forbearance. I mean, we're going to eventually foreclose on people. In fact, we looked at the 1.9 million people that are currently in forbearance. I think now that that will expire and the CFPB will step in from September to December, and they will protect the buyer, and the servicer is going to have to jump through hoops to ever foreclose on someone, but there will be foreclosures. And there was roughly
I don't know about that, Ivy, because
Oh, wait, let me
25.
finish.
Okay.
170,000, which is very little, less than 2% of those in forbearance, they were pre-COVID delinquent. They'll be the first people to get
Got
foreclosed.
it.
That's tiny. So I would just say very little will come to foreclosure, which is still, to your point, not enough inventory to mitigate the fact that we have a shortage.
Yeah, and don't forget, 25% of those people in forbearance have been paying their mortgage. Many people didn't need forbearance, and many people have gotten their jobs back. And the balance of them will probably not go through a foreclosure proceeding because they have inventory, they have equity to protect. So
Right.
yes, the numbers are going to be.
They might sell. They might have to sell, even
sell.
though they won't be upside down. There might be some inventory loosening up on the market a little on the margin.
So the point being is that I want to make one more point. Then I want to ask you about the Fed, what the Fed could or should do at this point in time, because there's been a lot of talk about this. Is the Fed is getting pressure to stop doing it. But the other point I did want to bring up is on the year-over-year comparisons. They're so wonky right now because June sales would be typically a little less than April or May, because we know that the big thing is you want to get your kids settled over the summer month. You want to close by the summer so that your kid doesn't be, as much as you can potentially avoid it. You'd rather avoid your child in the middle of the school year, because we know how rough that is. We all grew up and understand what that's like, whether we went through it or saw people go through it. So you look at the charts and it's like this, the peak comes in literally in the spring buying season. It's named that for a reason, not just because there's flowers, but because people want to close by the summer and start the school year. So normally you get year over year comparisons, but last year we didn't have that rush because schools were closed anyway, right? So then as it opened up, people weren't thinking, oh, this is a typical June, plus the pent up demand. So when we look at the slowdown, I think we had some rush from pent up demand, less concern over the seasonality that would normally transpire in June. So the slowdown this year is going to look odd on a year over year basis. If you look back 2 years, it's not that unusual to see where we are, So there's that. And then Ivy, I wanted to ask you, the Fed's coming under pressure. Hey, the housing market's too hot. You're fanning the flames by buying mortgage-backed securities. Let's stop that. What I'm saying is, I think that the Fed's been too aggressive to begin with, but, be careful what you wish for, because the appreciation that you're getting, it hurts the new entrant, but it's doing a lot of good for the economy and cash out refinances and being able to avert foreclosures in bad situations. So it is a double-edged sword. What should the Fed do?
Well, I don't know. I wouldn't want to be Jerome Powell right now. I certainly would not want to be in his position, but I can tell you that to me, it feels like the Fed, and I'm not a Fed expert, so this is just Ivy's opinion. I feel like they're the bartender serving a drunk crowd, and they keep serving more and more, and eventually the drunk, person passes out. I mean, when it happens, I don't know, but the backlash is that rates can never go higher. The debt service for the U.S. government can't go higher because it can't afford it. We have a debt ceiling we're going to breach. We have mortgage rates where it's like people will never leave, they'll never move again. Over 60% of people are locked in below 4%. The mobility of this country, except for, of course, our billionaires and millionaires that can affordability busters. And the media is so wrong about, people leaving big cities and leaving all these high cost states. I mean, in the state of California, 0.3% left the state in 2020. So, and that's been going on, by the way, the great American shuffle has been going on for decades, where the mountain states in the Southeast and Florida, so I think there's so many things that the Fed is not appreciating about the free money. But what really I think is they need to stop buying mortgage-backed securities. They need to stop, because the affordable home, that market is now so out of reach for primary owners. And that's the only way they can create long-term wealth, assumingly they're not, fortunate to have access to the stock market and other means to create long-term wealth. My best friend in Salt Lake, she didn't buy her house, and today, which is pretty much paid off, 6 grandchildren, she would never have wealth. So ownership, to have a variable rate, is very difficult if it goes up every year, as opposed to a fixed rate mortgage rate. So the Fed is fueling this fire, and we only know what the Biden administration is trying to do is put gas on that fire with more policy to accommodate demand. We don't need more demand.
Bingo. Bingo. Yes, we agree 100%. Now, here's the other thing too, is that I want to underscore.
And would you talk about, just for a minute, tell the audience, because my audience wants to know why rates are falling right now. Is it the Delta variant? Is it because the fact is everybody knows that the Fed is basically gonna, or not the Fed, that the government is gonna, the debt ceiling is gonna be breached? Well, why is mortgage rates for those, or treasuries first and then mortgage rates?
So treasuries are predominantly behaving so well because there is fear that we're going to see a big slowdown in GDP. We may be approaching recessionary conditions in 22 and 23. So that's a normal factor. We think that there's also a belief, at least, that inflation, while some of it will be sticky, will dissipate. There's also the fact that from a foreigner's perspective, the yields here, while they're low, are many multiples of what they can achieve in their country. So there's an influx of foreign capital coming in. And then you have the Fed monetizing it. I mean, the Fed's just buying so much. Now that really comes into play on the mortgage side, where if you have any kind of a slowdown in mortgage debt coming to the market, in other words, all the closed loans that then get converted to mortgage-backed securities that get sold, if that slows down, and it has slowed down, we know that volumes are slower, they're still good, but that slowdown with the same amount of Fed buying means that you're crowding out other buyers. So they're going to be bidding more to put those in their portfolios. You add to that the aging of Americans, and we know that that's happening. Then those aging of Americans, you have the transfer to some safer assets. For many people, the stock market is just too rich for them. And even though you can't get squat in the bond market, it's more about capital preservation than capital appreciation.
Well, that's why they're buying houses, because they want to rent them out or hold them to flip them.
Exactly right. That's exactly right. So Ivy, I wanted to mention the point that you had said earlier, and I want to try to remember what it was, because it was a good one, in that interest rates are going to limit the amount of inventory that comes on the market as fresh inventory. Because if you think about that person who now, fortunately they've seen appreciation, but they have a low interest rate, and should interest rates rise, they not only have the whammy of going to a step up, probably, because most people do step up when they purchase a home. That step up, at least, when you're in that 30-year-old cohort, the 40-year-old cohort, those buyers are going to be facing real challenges in price. But then you multiply the differential in price by the increase that they'd have to go to in interest rate, and it's going to give people pause that maybe I should go to Home Depot or Lowe's and fix up what I've got instead of biting the bullet. Now, we don't have that quite yet because we don't have the increase in interest rates, but that has to be something that's in the back of the mind.
Yeah, and I've been so afraid of that. And then people that you and I both respect, like Lacey Hunt and Daniel DiMartino Booth, and rates, you're better at forecasting rates. We don't forecast rates, but doesn't seem like rates are ever going to go higher. So maybe that fear that I've been sort of really, really focused on about mobility shutting down is just not going to be here. I don't know. But, technology and automation and the improving aspects of efficiencies, those are good things that are happening in the economy that are reducing consumer friction. People can buy homes online now. There's good things, not all bad. But right now, today, the US housing market is starting to inflect. The buyers are starting to push back. And we are going to see that the affordable market is where you're seeing the greatest suffering. And I think the luxury market is going to continue to do well. The second home market, if you think that the 10 years going back to, 1, or could even go below that, as long as there's free money, the party's going to continue. The sobriety is not around the corner. The party's going to continue. And by the way, people have no choice. You said it. You think about all the money coming into the US, we're the tallest midget. We are the tallest midget. So that means more money, more pressure on yields.
Ivy, is there a world, and we've kind of talked about this, and we've maybe suggested it, but I don't know, but you said it before. We believe it's ridiculous to try and create policy that is focused on demand. I know it sounds good, it buys votes, but it's just flat out stupidity. However, is there a world where they say, and it may be loath to do this, the real problem is supply, and the real problem is the cost to bring that supply to market. So if a builder is willing to build in this price range, depending on the zip code or MSA, whatever, 80% below the median home price in that MSA and deliver a home that will help you do that by subsidizing you in order to do that. Is there ever a world that could happen to facilitate that, in your opinion?
Well, you have to understand the local markets have what's called impact fees. So there are fees that the developer, it's all pushed to the developer for schools, for fire departments, police departments, all the fees. So you go into a market, Houston has the lowest impact fees as a percent of lot cost of any market in the country. You go into some of the most expensive countries or markets, and it's 50% of your ASP. So like the impact fees are such a deterrent, and you can't make a return because of impact fees. And then you have FHA loan limits that also curtail the ability for affordable housing. So you can't build, because if you have a FICO score below 620, you're not getting FHA. And if you're below the loan limit, so we did a piece back many years ago, Alan Ratner would remember, I think it was probably like 2015, about the intersection of FHA loan limits and impact fees. And we went to policy people and in both FHA and Fannie Freddie said, look, what someone needs to do something here, because you got to raise the FHA loan limit or lower the fees. So this idea that the administration has talked about zoning and that they're going to help by trying to improve zoning, nobody wants it in their backyard. The constituents that the legislators in this country want to be voted for in local markets, they will not be voted in if they let all this affordable housing in their backyard. Nobody wants it in their backyard. So I would love it if we can see improvement in zoning and see more municipalities approve affordable housing to build and subsidize it. But I am very dubious that that will come to fruition. And certainly the federal government can't do anything about it. At least I don't think they can, not in any big way.
Well, Ivy, by the way, those of you listening, if you're not following Ivy, if you're not tapped into her, I mean, you're just crazy. I'm so blessed that I get to chat with Ivy all the time because we're dear
I'm
friends.
blessed to talk to you too.
Thanks, Ivy. Yeah, we're both we're big fans of each other, which is great. I'm your biggest cheerleader. I'm so appreciative that you took time with us today. I want to just bring Diana back on just for a second. And Di, would you please tell me, and Megan's on as well, but Megan's a little under the weather today, but she's such a trooper. She's on. I just want to give her a shout out because she's so dedicated, and she'd be on. Yeah. So Di, are there any questions that just in the next 5 minutes before we wrap up, because I want to be very respectful of people's time. I want to keep this about 45 minutes. So for about 5 minutes or so, are there questions that you're seeing there that you think we should answer, Di?
There are a few really good ones. And first of all, Ivy, you are a powerhouse, both you and Barry. People are really enjoying today's session. I am taking notes as well. So we love you. Thank you.
Appreciate it.
A couple questions. One from Michael. Regarding the gold or silver standard, do you think the Fed eventually will collapse due to the debt ceiling, due to inflation concern and devaluation of the US currency?
Thanks for asking a question, Michael. That is way beyond my expertise, so I cannot help you. I will pass to the next one. Sorry.
Let's take a couple more. And Barry, too, we had some for you as well. So Ali's asking, is there any conversation in regard to taking commercial use properties and transitioning or converting them to multi-use family, since a lot of companies have gone to remote work opportunities?
I hear a bit more anecdotal about it, but today we have record levels of multifamily under construction that has yet to be completed. So there could be, an argument made that we're going to oversupply multifamily. If you're taking, therefore, commercial assets, whether it be retail, hospitality, and office, and trying to convert them to residential in a market that's already arguably, depending on the market, has tremendous amount of supply in the pipeline, I don't know that that's going to happen that quickly, nor do I expect that it would be easy to go to rezone. So, but there are some stories of that or anecdotes that we've heard.
Great. Thank you, Ivy. And maybe for Barry now too, Joshua was asking, he's curious how you see today's marketplace impacting second lien availability and how it compares to personal loan debt that is out in the public today.
So second lien availability is should probably be broader because there's so much more equity. It's going to be a lot easier to get that, and it opens up the door to in the future, I think, will that impact refinances? So refinances are going to be your first choice if you're lowering your rate on the primary mortgage, on your first mortgage. But if interest rates do move up, those second liens become more in vogue, so you can preserve that first mortgage. However, as we've discussed earlier, we think that there's a good chance, it's not going to be in a straight line, but over time, we see GDP, and the estimates for GDP are already slowing through the rest of this year. You're looking at 9% in Q2, and then it drops and drops and drops. By the time you get to Q1 of 2022, I'd be surprised if it's peaking above 3%. So it could be much less than that. And that steep decline is similar to what we saw in 2020. As the stimulus wears off, that effect kind of rubs off, and then you just see the debt that's remaining, which weighs things down. Based upon that, it wouldn't surprise me to see interest rates, as we've discussed with Ivy, remain very favorable. Not a straight line. Doesn't mean they can't go up a little bit for a period of time and come back down. But I would not be shocked if we challenge in 2022 or 2023 the all-time lowest closing yield on the 10-year, which is 0.5%, which I'm very proud that I called right on Fox before it happened. And also to see potentially recession or recession-like conditions.
Great. I don't see too many other questions. If one comes in, of course, I'll mention it, but I did want Ivy to speak a little bit about her 2021 Virtual Housing Summit. I know we have a nice special offer to share with our group here.
Well, thanks for reminding me, Diana. So we are hosting a virtual housing summit the week of September 20th. And if you're interested in attending, we are giving our MBS Highway friends a discount, and you can reach out directly to kim@zelmanassociates.com. I think that's what I was told to say, right, Diana? Is that right?
That's right. They can reach out to Kim, but I also just made a comment in the Facebook thread that you can go to zelmanhousingsummit.com/2021 and use code MBS Facebook. So a couple.
And will you put if you probably already did it, but will you also put Kim's email address in there too, so they both have it?
Just for everybody to know, I'm very proud to have Dr. Michael Roizen, who's a friend of MBS Highway, will be joining me virtually, as well as Danielle DiMartino, another friend of MBS Highway. So we've got a lot of great content, and we do panels, and Dennis McGill, my co-founder, partner, will be opening with the State of the Nation's housing presentation. So it's really, I think, great content. And right now, the industry really, this is the time where you really want to sharpen your pencils, and you want to be focused, and you want to be abreast, and utilizing MBS Highway and hopefully Zelman will hopefully keep you ahead of the curve and help you navigate, because it's going to be troubled waters, I think, going out there.
Yeah, I was honored to speak last year and attended the whole thing. It's great, guys. It's really great. It's a must for everybody. Ivy, thank you. We love you. Thank you. Thank you. Diana, thank you. Megan, thank you. Guys,
bye, everybody. Bye.
Thanks for everybody for watching. Bye-bye.